Welcome to end of the IFRS Spotlight tutorial Samuel. In this episode, we'll be discussing updates on IFRS Accounting Standards. We want to take a quick overview over all the existing standards, that the standards that apply or that are applicable either in the current reporting period or in the future, leaving out all those standards that have been superseded or overridden by a new standard that have been issued. So the first standard is IS1. IS1, presentation of financial statements. The standard deals with the core component of a typical IFRS financial statement, specifying statement of comprehensive income, statement of financial position, statement of changes in equity, statement of cash flows, notes to the financial statements, then disclosure of significant accounting policies, and other explanatory information. So IS1 prescribes all of this information that needs to be presented and the nature of presentation in the face of IFRS set of financial statements. The next standard is IS2. IS2, titled Inventories, deals with all categories of inventories. It defines what an inventory is for a preparer to know the status of what constitutes an inventory and the various classifications of inventories. So raw materials, partly finished goods, and other consumables as the case may be. So this data specifies how these items that constitute inventories are recognized, measured, presented, and disclosures made in line with the provision of IS2. Then we have IS7. IS7 is statement of cash flows. Statement of cash flows itself is a component of the core IFRS financial statement as contained in IS1. However, IS7 is dedicated to providing detailed consideration of how the cash flow information are presented in the statement of financial position and the methods that are used. The use of the direct method, the use of the indirect method. The direct and indirect method is limited, however, to the operating activity section of the statement of cash flows. The investing and financing activity sections are the direct method. Cash flows are reported gross, either for the gross cash inflow or gross cash outflow. That is the purpose of IS7, statement of cash flows. Then we have the IS8, titled Accounting Policies, Changes in Accounting Estimates and Errors. IS8 has three sections. The section that deals with the considerations, the judgment, evaluation that has to be done by an entity in developing an accounting policy or in selecting accounting policy. And also, where there are changes to those policies, ISA prescribes the concept of retrospective application. That is, when a new standard or a change in accounting policy is applied starting from previous period, as if those changes had occurred at those previous period. So that section of ISA deals with how accounting policies are selected, how they are applied, and even how they are changed when there's a change in accounting policies. Then the second portion or the second section of IS8 is on changes in accounting estimates. When there are changes in accounting estimates, IS8 defines what constitutes change in accounting estimates. So IS8 prescribes the approach or outlook of presentation in the face of financial when there is a change or when there are changes in accounting estimates. So the common term is prospective application whenever there's a change in accounting estimates. Then the third portion of IS8, or the third section, is the section that deals with errors committed in prior period discovered in the current period. So they are called prior period errors. So IS8 prescribes the procedure and disclosure related to retrospective restatements. So when errors are corrected, apart from the accounting entry of what to debit or what to credit or what to reclassify, in the face of financial, IS8 prescribes how those retrospective restatements are presented and associated disclosures contained there. So that is IS8 on accounting policies, changes in accounting estimates, and errors. That's the name of IS8. Then we have IS10, titled Events After Reporting Period. IS10 deals with those activities or transactions or information that are coming to the knowledge of a preparer or an entity, but this set of activities, information are arising or they become known after the end of the reporting period and before the date the financial or financials are approved for use or issuance. So if an entity's financial year ends on December 31, 2023, and that financial is to be approved by the board on February 1, 2024, so that the time lag between December 31, 2023 and February 1, 2024. Some information may come to the knowledge of the entity or to the preparer. Those information may signify that certain events had occurred on or before December 31, which was not known to an entity, or certain information occur after December 31, but before February 1, when the financials are authorized for issue. How are those transactions, or how are such information considered? So IAS 10 prescribes about adjusting events or non-adjusting events. Depending on the nature of the information or transactions or events or conditions that have arisen within this period. So it prescribes when the financials are adjusted for such developments or when such financials are not adjusted. Such events are not made through disclosure but not adjustments. So adjusting or non-adjusting of an item, the considerations are provided under IAS 10. IAS 10 also refers to the need to stipulate or specify the body or group that authorizes a set of financial statements, and also the need to disclose the date that a set of financials, is authorized. That is IAS 10. We have IAS 12. IAS 12 are income taxes. This standard deals with current taxes and deferred taxes. However, taxation is a function of law in different jurisdictions. So IAS 12 relies on the tax laws enacted or substantively enacted in prescribing the way current taxes and deferred taxes are recognized, measured, presented, and disclosed. So it is based on the existing tax law or tax laws of tax framework in a reporting jurisdiction that prescribe the approach of application of IAS 12 in that jurisdiction. There is the IAS 16. IAS 16, property, plant, and equipment. This is the standard that deals with tangible long-term assets that are not expected, that will be used for a period beyond 12 months, and they are tangible in nature. So IAS 16 prescribes the various classes of those items, like land, like building, like an oil rig, biological assets, specifically the one that has to do with bearer plants, because other biological assets are contained in a different standard, but bearer plants, motor vehicle, plant and machinery, office furniture, office equipment, computer equipment, that is hardware. So all of these items, concerning how they are recognized, measured, classified, or presented, and disclosure made, are all provided for under IAS 16. And there is the IAS 19, which is employee benefits. This standard stipulates how recognition, measurement, presentation, and disclosures are made concerning the various kinds of employee benefits, whether they are short-term employee benefits, whether they are other long-term employee benefits, whether they are post-employment benefits, and whether they are termination benefits. And also, it also deals with certain aspects of share-based payments that are attributable or that are accrue to employee. So IAS 19, titled Employee Benefits, deals with all of these, as they affect these 5 categories of employee benefits, how they are recognized, measured, classified, presented, and the associated disclosure concerning these items. There is IAS 20. IAS 20 is titled Accounting for Government Grants and Disclosure of Government Assistance. When an entity receives grant, first of all, the standard describes or defines what a grant is and what a government assistance is, and differentiates what does not constitute a grant, neither does it constitute assistance. For example, general welfare infrastructure provided by government, provided for everybody in an area, does not constitute a government grant, nor does it constitute a government assistance in the context of an entity applying IAS 20. So the standard defines what a government grant is, what a government assistance is, and those other interventions by government that are neither government grants nor government assistance. So the standard prescribes how grants given to an entity is reported, the conditions that need to be fulfilled, how the grants, how the resource received or receivable are treated based on the ability of an entity to meet that grant, and what happens when a grant is conditional or not conditional. What happens when a grant is in the form of a tangible assets given, like the PPE and the likes, and where the grants are what are considered, income grants. How all of these are presented, the way they are recognized, the way they are measured, and the way they are presented. Are they presented net? Is a portion presented as a deferred revenue or deferred income? Is a portion presented as a netting from the PPE already incurred by an entity for which an offsetting is done? All of these considerations concerning government grants and assistance are dealt with under IAS 20. And then IAS 21. IAS 21 deals with the effects of changes in foreign exchange rates. The effects of changes in foreign exchange rates. For transactions entered into by an entity that are not done in the domestic currency, what is called functional currency. In Nigeria, our functional currency is the Nigerian naira. So there may be reason or there may be unavoidability that an entity will have to deal in foreign currency. So when the foreign currency transactions will need to be converted or certain operations translated into the Nigerian naira, which is the functional currency, the issue of foreign exchange gains or foreign exchange losses arise. The issue of foreign exchange gains or foreign exchange losses arise in those conditions. So how are those differential triggered by changes in exchange rate? How are they treated? That is what IAS 21 deals with. Also, a Nigerian entity consolidating a foreign subsidiary's financial is presented in another currency. So that is converted and translated into the Nigerian naira. So such foreign exchange differences, the net monetary difference from such conversion or translation, how are they treated in the book of the reporting entity? IAS 21 also deals with that. So apart from transactions engaged in an entity that are foreign currency based, there may be foreign operations that need to be converted or their affairs translated for integration reporting by the domicile entity or the reporting entity. IAS 20 gives all of those provisions, how they are recognized, how they are measured, how they are presented in the face of state of comprehensive income. Those ones have to go with profit or loss, those ones have to go with OCI, those ones that may go either way, and now foreign operation transaction reserve is then presented. And when there's a disposal of foreign operation, how the accumulated reserve is recycled into retained earnings or recycled through profit or loss, as the case may be. That is IAS 21. There is IAS 23. IAS 23 is titled Borrowing Costs. IAS 23. When an entity incurs borrowing to fund certain category of assets, the condition in that standard is the interest associated or the transaction cost associated in borrowing to finance or funds those assets. How are those costs, interest and transaction costs, be treated? Are they to be expensed in the period they arise, or are they to be capitalized as part of the cost of those assets? So in IAS 21, there are description of assets called qualifying assets. When funding or borrowing is made to enable the purchase, acquisition, construction, and installation of certain assets, or to engage in certain assets. So there's a feature they are described. So such funding costs or finance expenses incurred are capitalized if those assets fall under what are called qualifying assets. Financial instruments do not fall, financial assets do not fall under qualifying assets under IAS 21. Neither do inventories that are just bought to be sold. Inventory that do not take certain substantial period of time for such inventory to be manufactured for sale. So there are considerations. So for those qualifying assets, IAS 21 specify when finance costs or transaction costs associated with acquisition, construction, or installation are capitalized and when they are expensed. It also deals with when capitalization should be suspended, and when capitalization of these finance costs should even cease. That is IAS 23, borrowing cost. There's IAS 24, related party disclosures. There are transactions between an entity and certain group of persons or entities described as related party. Related parties may be individual, they may be entities. So the description, whether they're individuals or related party, those who have any dealing of any sort within certain framework are classified as related party. They may be subsidiaries, they may be fellow subsidiaries, they may be parents, it may be a parent, it may be the director of the entity, or it may even be the key management personnel, KMP, those charged with planning, controlling, and directing of an entity, whether they're MD, GM, ED, whatsoever. So those transactions concerning between an entity and this group of persons or entities, correlated parties, are required to be disclosed in certain form. Disclosures are required as to, e.g., what are those transactions? What is the value? What is the current amount at the end of the year? How much has been written off? Are that collateral associated? What is the name even of related party? What is the nature of the relationship and all of that? They are all contained in paragraph 18 and thereabout in IAS 24 as to what and what to disclose. Is a disclosure standard. The next one is IAS 26. IAS 26 is accounting and reporting by retirement benefit plans. Accounting and reporting by retirement benefit plans. This standard applies in Nigeria to pension fund administrators only. Pension fund administrators, any entity that is incorporated and charged with the collection of pension contribution and management of such is required to keep a separate accounting record, a separate set of financial statements dealing with those plan collections. It is contribution on the part of the employer. It is collection on the part of the PFA, pension fund administrators. So those plan collections and the plan assets where they're invested in. So in the case of collection, contribution collected, investment made in line with investment guideline by PENCOM, right? And also the policy of the PFA. So where they invest, there's a comparison between the financial assets, the investment made, and the collections, the collections effected or contributions made. So IAS 22 requires an entity to have a separate set of financial statements for the purpose of such plan, apart from its own financial statement as a separate entity. So IAS 22 applies to contributions and investment made through those contributions and returns thereon, another management fee, running fee, investment expense incurred in the process of managing such plans. So IAS 22 is only applied by a pension fund administrator. In Nigeria, we have the category we call closed pension fund administrators. These are PFAs owned by an entity that is in itself the contributor of the contribution. However, a separate entity is established to manage such contribution and the plan associated with the contribution mobilized. So if you mention some of the multinational, they have their own PFA, they are called closed PFA. Then we have the open or general PFA, right, that can mobilize collection from any qualifying employer in Nigeria. So the summary is this: IAS 22 is only applied by a pension fund administrator, whether as a general or open pension fund administrator or a closed pension fund administrator. That is IAS 26. There is IAS 27 titled Separate Financial Statements. Separate Financial Statements, IAS 27. When an entity has an investment in another entity, the question is, how is that investment measured? How is it accounted for? How is it accounted for? When the investment in that other entity makes that entity either a subsidiary, either an associate, or a joint venture, for example, how is the investing entity, not the investee, how does the investing entity account for such investment in its own standalone, not in a consolidated financial? In its own standalone financial statement, how are such investments accounted for? So the standard prescribes that such investments can be accounted for at cost, at fair value in line with IFRS 9, or using the equity method. So in the book of the investing entity in his own column of his book. So those are 3 measurement bases for such investment in subsidiaries, associate or joint venture. So if you look at the typical group financial statement, you see a column for the parent. Yeah, you see a column for the group, there's a column for the parent. That column for the parent is the composition of his own separate financial statement. A separate financial statement generally is that presented alongside a consolidated financial statement. A separate financial statement is that presented alongside a consolidated financial statement. That is why you see the column for the group, the column for the parent. So the investment, in the group, there won't be anything called investment. Everything is consolidated in the group column. All the assets are merged, liabilities merged. For the equity, the non-controlling interest is adjusted and reported separately. But in the book of the parent, aligned by the consolidated, the investment in such other entities are still carried. So IFRS 27 prescribes when or how those investments can be carried, either at cost, at fair value in line with IFRS 9, or carried or what we call equity method accounting. That is IFRS 27. And as IFRS 28, IFRS 28 deals with investment in associate and joint ventures. IFRS 28 prescribes about equity method accounting, the procedures, the consideration, the measurements that applies when an entity has investment in associate or joint venture that are equity method accounted. That is IFRS 28. Then there's IFRS 29, financial reporting in hyperinflationary economies. IFRS 29, financial reporting in hyperinflationary economies. In economies that are hyperinflationary, in a given year, the current year will be reflecting transactions based on the hyperinflationary situation. However, in the outgone or prior period, when the inflation had not been officially reflected or commenced, presenting the prior year information alongside with the current year that is suffering hyperinflation is going to lead to non-comparability or a distortion. Therefore, such comparative years are required to be restated into similar basis with the current year that is undergoing hyperinflation. That is the purpose of IFRS 29, financial reporting in hyperinflationary economies. There is IFRS 32, financial instrument presentation. IFRS 32 focuses on evaluation that is done in determining whether a financial instrument constitutes an equity instrument or a liability. That is the purpose. It deals with the consideration, when does an item qualify as an equity instrument, like an equity? When does it qualify as a financial liability, like your redeemable preference share? So it's not automatic. So the behavior, the article of association of an entity is reviewed to determine the implication as to whether that instrument has the right or is limited to having rights to residual payment, or whether it has preferential rights to certain earning before net assets is made available to other categories. So an evaluation is done under IFRS 32 to decide whether a financial instrument should be classified as a financial liability or as equity, depending on the provisions of the contract governing such instrument. That is IFRS 32. There is IFRS 33 that deals with earnings per share, whether it is basic earning per share or diluted earning per share, and all the disclosures that needs to be made when there are other development as to equity issue that affect the calculation of whether basic or diluted earning per share. That's IFRS 33. Then there's IFRS 34, interim financial reporting. For quarterly reporting, half-yearly reporting, 9-month reporting, there are items that are not analyzed. Some are proportional, some are disproportionate. How are all of these dealt with? And what is the nature of the condensed or a brief financial to be presented? IFRS 34 gives that guidance. Then there's IFRS 36, impairment of assets. For assets that suffer impairments, apart from financial instruments that has a dedicated standard on impairment, Chapter 5 of IFRS 9, this is an impairment for certain financial assets, not all. And apart from IS2, that deals with something kind of impairment concerning inventory. So IFRS 36 is dedicated to impairment on non-current assets largely. And what happened to allocation of impairment to what is called cash generating unit, the first component of cash generating unit and the likes. That is IFRS 36, dealing with impairment. Then there's IFRS 37. IFRS 37 is titled Provisions, Contingent Liabilities, and Contingent Assets. When an entity is to make a provision, IFRS 37 gives the prescription. Because provisions are kind of is a liability, but they're kind of different. Provisions are liabilities that are uncertain in timing or amount. They are liabilities. However, there is special liabilities because they're uncertain in either the timing of meeting the obligation or uncertainty in the amount. So provisions are not just specific liabilities, neither are they accruals. No. So IFRS 37 gives that guidance on what are provisions and how provisions are measured and associated disclosures that are required to be made. IFRS 37 also gives the contingent assets and contingent liabilities. These are assets or liabilities that will arise on the occurrence or non-occurrence of a future event. It is not defined. So generally, for contingent asset or liability, they are disclosed in financial, not recognized as part of asset, liability, income, expense, or equity. No, only disclosure serves for contingent assets and contingent liabilities. Then there is IFRS 38, intangible assets. So for those long-term assets, but they are non-tangible, they are non-physical, they can't be touched, right? But they have the capacity to generate economic benefits to an entity. They can be identified, they are under the control of an entity, and they can generate future economic benefits to an entity. So IFRS 38 gives classification of what constitutes intangible assets, not just anything abstract. No, it has to meet those filters of identifiability, control, and the ability to generate future economic benefits, even though they are non-tangible. Copyright, patent, franchise, and the rest of them. So IFRS 38 specify, and also when expenditures are incurred on this item, when are those expenditures expensed? When are those spending expensed? And when are they capitalized for what may be considered internally developed intangible assets? There are a few that must be met before such expenses are capitalized. The filters of have we gotten up to the stage of development? Is that a commercial viability? Is that a demonstrable possibility that this is going to be actualized? And all the filters, they're all stated there. But when spending for the purpose of any sort of intangible asset being developed do not meet those criteria, those spendings or expenses are written off. They are not capitalized as intangible assets. So IFRS 38 gives the guidance, the recognition, presentation, and disclosure associated with these items. Then IFRS 39, financial instruments, recognition and measurement. All provisions of this standard have been replaced by IFRS 9, except for the hedge accounting provision. For entities that still use the hedge accounting provision of IFRS 39, they are allowed to continue to use such an accounting provision until that transaction runs out. So no other content is in there in IFRS 39 except for hedge accounting under the auspices of IFRS 39. Then there is IFRS 30, that is investment property. Then there is IFRS 41, IFRS 40. I'm not trying to emphasize it because it has a whole lot look alike, like your land and building under IFRS 16. However, it is the purpose that differentiates. It is held for either rental income generation, capital appreciation, or both, but not held for use in administration, not held for use in the running of an entity, held for rental income generation, capital appreciation, or both. It could be land, it could be building, it could be land and building. And we have IFRS 41, agriculture. For biological, what are agriculture defined biological assets, plants and animal. So for the produce, for the plant and animal itself, how are they measured? So that standard specified there's a category of biological assets called bearer plants. They are considered PPE and they're reported in line with PPE, e.g. a tree that gives, that produces fruits. For example, that tree itself is measured in line with IS 16, even though it is a biological asset. But the produce and all of the rest are dealt with in line with IS 41. When a produce matures, or when a produce is harvested, from that point, it becomes an inventory. But before the point of harvesting, every single thing reported in line with IS 41. Then we have IFRS 1, first time adoption of IFRS. It prescribes changes in accounting policy, exemptions, exceptions, and relief granted to a first time adopter. There's IFRS 2, which is share-based payments, where payments are to be made by an entity either to its own shareholders, to his own employees, or to his suppliers or vendors. And those shares are to be measured at fair value and with certain conditions that need to be met, called vesting conditions, the case may be. So IFRS 2 gives the guidance of what is to be done. Then we have IFRS 3, business combinations. When there's a merger or when there's an acquisition, right, they are treated as a business combination. So this standard stipulates how goodwill is determined, qualifying assets, how they are made at fair value, how non-controlling interest is attained, and if a transaction lingers on beyond a certain period, there may be contingent consideration, payment to be made in the future if certain conditions are met. So IFRS 3 deals with how goodwill is attained, those other contingent considerations, and how to treat deferred tax arising on certain assets that are taken over. And all other things that have to do with the acquirer and acquiree, the measurement of assets, the measurement and subsequent reporting, and what adjustments are made, and within what period every transaction concerning contingency in a merger acquisition should be completed. That is IFRS 3. IFRS 5, non-current assets held for sale and discontinued operation. When a non-current asset, a building, land, motor vehicle, is classified as held for sale, they are reclassified out from your non-current assets, current, and presented separately in the face of state of financial position. Same thing, when an operation, a component of an entity is being discontinued, maybe there's a planned sale or discontinuation of operation, they come under discontinued operation. The profit or loss or the gains arising on such disposal or measured for a planned disposal are reported in a certain way in line with IFRS 5. We have IFRS 6, exploration and evaluation of and evaluation of mineral resources. Exploration for and evaluation of mineral resources. So when anything explores, right, and incurs an expenditure, from the date it is licensed to commence exploration to the period when those resources are found in their commercial quantity, the expenditure incurred between the moment of licensing or authorization and the moment that the non-regenerative asset, for example, is discovered, the spendings are required to be treated in a certain way. So there are conditions that must be met. However, this standard deals with those expenses incurred from the time of licensing, search, and up to the point where resources are discovered in their commercial quantity, and as evidence, right, that an operation is going to commence afterwards. So the expenditure incurred within this window are treated in line with IFRS 16. Ordinarily at start, they are all called exploration expenditure. Now, when certain conditions are met, they are reclassified as exploration assets. They could be tangible, they could be intangible. After the period of discovery and certainty of commencement of production, the intangible component is treated as intangible assets under IF 38, and the tangible component is treated as tangible asset under IAS 16. But that is from the moment when production is to commence, commercial viability, and sustainability of that project or that entity is confirmed. But all the while within that period, they are either exploration expenditure or tangible exploration assets or tangible or intangible exploration assets before they're finally classified ultimately to report in line with IAS 16 or IAS 38 as the case may be. Then at IFRS 7 that deals with financial instruments, the disclosures, it's not about measurement, disclosures for various categories of risk management and all the types of risk, say credit risk, liquidity risk, and various type of market risk. That is IFRS 7, is a disclosure standard. There's IFRS 8 on operating segments. This standard stipulates what constitutes operating segment, not just any department or division, no. So there's a quantitative threshold in revenue, there's a quantitative threshold in assets, and other non-quantitative threshold that should be met before a component of an entity is called an operating segment. So the disclosures concerning geographical spread or location, preponderance of customer size of transaction, product type, and the rest concerning each of these segments are all as prescribed under IFRS 8. Then we have IFRS 9 titled Financial Instruments. This standard deals with every single thing that has to do with recognition, measurement, classification, impairment, and hedge accounting concerning financial assets in all form, and also financial liability, and also there are certain accounting for equity instruments. So that is the provision of all of these standards as a whole. So IFRS 9, so it is meant to replace IAS 39. It has replaced, except for the hedge accounting provision of IAS 39 that was referred to. However, all other hedge accounting provision under IFRS 9 are what apply. Those provisions are what apply for hedge accounting, other than those entities that are still using the hedge accounting provision of IAS 39. Then we have the IFRS 10, consolidated financial statements. These deal with the presentation of financials of a parent and its subsidiaries as if there is a single entity. That is consolidated financial statements. While IFRS 3 is used to determine goodwill, right? When there is a merger or an acquisition or a pooling of interest, this data deals with how the assets, liabilities, equity, and non-controlling interest are presented both in the face and a certain note associated with the consolidation. That is IFRS 10. We have IFRS 11, joint arrangements. When an entity goes into a joint venture or what is called joint operation, the approach with which it contributes its assets or resources and the approach of sharing of resulting profit or net asset or such venture determines whether such transaction is classified, such investment is classified as a joint venture or a joint operation. So joint arrangement could be joint venture, it could be joint operation. And whether it's a joint venture or joint operation, defines how the assets or defines how the resources contributed or brought for such, such activity, are presented in the face of the financial. That is IFRS 11. When it comes to the equity measurement of a joint venture, the provision of IAS 28 is applied when joint ventures are measured using the equity method accounting. So the provision of IAS 28 applies. So the next one is IFRS 12. IFRS 12 is titled Disclosure of Interest in Other Entities. Disclosure of interest in other entities. When an entity invests in other entities, whether those other entities are subsidiaries, associates, or joint ventures, or even other special purpose vehicles, IFRS 12 prescribes the disclosure that should be made concerning every single subsidiary, joint venture, associate, or even certain special purpose investment made by an entity. So IFRS 12 is the disclosure standard. Then we have the IFRS 13 fair value measurement, the almighty fair value. How is fair value measured? It identifies three hierarchy of fair value measurement: level 1, level 2, level 3. When there's a market, when there is a fair value that is verifiable in what is considered a principal market, or even a most advantageous market, for example. Now, where certain fair value cannot be determined because there is no such principal market or there's no such advantageous market, right? But a comparison can be done of a sort. You talk about level 2. Now, in level 3, nothing, no kind of fair value can be determined in any other way. So certain valuation techniques are used to determine the fair value of those assets, those liability obligations, for example, or those equity instruments relevant, depending. So what are other yardstick? Now, when there is no objective way of measuring it in the level 1 approach, there is no comparable metrics in the level 2 approach, it boils down to valuation. So we have certain approaches, income, markets, and all the rest approaches. So all of these are dealt with under IFRS 13, fair value measurement. IFRS 14 is titled Regulatory Deferral Account. Regulatory deferral account. This is a special purpose standard that applies only to an entity that has transited into IFRS that had before then measured what are called that is involved in utility regulated industry, where there is a government agency or a government body that regulates certain transactions because of the welfareism impact of such industry. And entity is not allowed to price commercially from the outset. There is a rate regulation. As time goes on, the revision of that pricing, the ability of an entity to review its price so that it can recoup its earlier investment. So that is the structure of the rate regulation kind of entity, a rate regulated kind of transaction that such entity is involved in. So when an entity is involved in such, let's say in Nigeria, let's use the typical example, the discos, the various discos in Nigeria, right? We are they're all called MITO, multi-year tariff order, for example. So if an entity has incurred certain expenditure that is unable to price commercially based on regulation of government, you discover that such entity cannot reasonably make profits because it is not pricing commercially. There's a regulation. So all spending by such entity are called regulatory deferral account debit balances. Regulatory deferral debit balances or debit accounts. So they are not classified as assets. They are separated. And also, any advance, any receipts, any benefits, taken by that entity is deferred into the future to be matched with the spending it has done. Those are called regulatory deferral account credit balances. Regulatory deferral account credit balances. So they are not called liabilities. They are not classified as equity, no. Neither are the spendings, which are regulatory deferral account debit balances, neither are they called assets. So these are special line items presented separately in the face of statement of financial position. But as I just said, IFRS 14 applies only to an entity that had been recognizing that kind of transaction before transiting to IFRS. When an entity never had anything similar, anything analogous to a regulatory deferral account debit balances or regulatory deferral account credit balances, when an entity has nothing analogous or similar or deep comparable in the previous framework before transiting to IFRS, it is not required to apply IFRS 14. Then there's IFRS 15, revenue from contract with customers. This has to do with your, in quotes, sales that are short-term and in quotes, sales that are long-term. Because IFRS 15 replaced IAS 18 revenue of old and IAS 11 construction contracts. For deposits given ahead, how are they treated? For a contract won, a construction price agreed. How does an entity recognize revenue? Does it book the entire consideration as revenue from day one, or does it need to meet certain milestone in line with the performance obligation? So there's what we call a five-step consideration. that is made before an entity recognizes revenue under IFRS 15. So all of these intricacies are provided for under IFRS 15. Then there is IFRS 16 leases. This will now replace the SYIS 17. The introduction of IFRS 16 is a lessee in an operating lease recognizes the right to that lease under what we call right of use assets, ROU, right of use assets, right? So it is not a matter of, it is not a lessor, or it is not a capital lease, or it's not a capital, no. For going to any transaction, IFRS requires that the economic valuation of that transaction is determined and reflected at the present value and brought into the book as right of use asset on one hand, with a corresponding lease liability on the other hand for a lessee. IFRS 16 does not change the reporting concerning a lessor in any form. It rather brought changes to a lessee in an operating lease on the need to recognize right of use assets and the corresponding lease liability. So the valuation and the components of what makes right of use assets and liability are contained in IFRS 16. Then IFRS 17 is titled Insurance Contract. This standard replaces IFRS 4, I beg your pardon, IFRS 4, the former insurance contract. Coming up with a whole lot of new provision, but IFRS 17 applies only to insurers and reinsurers. Only to insurers and reinsurers. Of course, it recognizes that insurance or reinsurers may be engaged in certain investment management, right, where returns are promised. So that is IFRS. It deals with insurers. It is for insurers and reinsurers who may engage in investment placing exercise, and whether the investor or the depositor has right into prescribing how the investment is managed and how the returns are shared and the likes of them. So all of these are contained in IFRS 17, insurance contracts. Then there's the new IFRS 18, which is presentation and disclosure in financial statements. Presentation and disclosure in financial statements. That is IFRS 18. It is a standard that is going to replace IS 1, but the mandatory date of application is January 1, 2027. The summary is that it specifies the focus of IFRS 18 really is on statement of financial performance. How income and expenses are now arranged to determine certain line item. So it emphasizes the need to arrange operating activity first, followed by investing activity, followed by financing activity, followed by income taxes. Then the last category, disclosure operation. So items are arranged in such a way that profit and loss is determined. Then profits are allowed before financing, before income taxes and financing are determined, and the rest of them. That is IFRS 18. So the main focus of the change is on statement of comprehensive income, whose the nomenclature has actually been changed under IFRS 18, known as statement presenting other comprehensive income. Statement presenting comprehensive income, rather. Statement presenting comprehensive income. That is the name for statement of comprehensive income under IFRS 18. Then the new IFRS 19 titled, yes, I'm correct. Subsidiaries, yes. Subsidiaries without public accountability. Yes. Subsidiaries without public accountability, disclosures. So it's a new standard that is applicable as at now. The purpose is to give a disclosure relief and reduce preparation costs for subsidiaries that needed to comply with IFRS disclosure when they are providing information for the parent. So IFRS 19 gives a toned down disclosure for a subsidiary that is to prepare financials to be relied upon by the parent in presenting a consolidated financial statement. So likely the toned down disclosure requirement is streamlined and a simplified disclosure that will enable an entity that is not publicly accountable. You see, the title of the standard is subsidiaries without public accountability. An entity does not have public accountability if its share or debt instrument is not traded. One, and it does not carry out a fiduciary activity of collecting assets from a broad group of people. It's not like a bank, a microfinance bank, an insurance company, and the rest of them. So that is what a subsidiary without public accountability is. Its shares or debts is not traded, one, and it does not carry a fiduciary asset transaction involving collecting resources from a broad member of the public. So these are the updates on IFRS from IS 1 to IFRS 19, titled Subsidiaries Without Public Accountability Disclosures. Thank you. It's been a long one, but it was necessary. We didn't break this into 2 episodes, as we can cover the length and breadth of all of these standards. So refer to them for the applicability as appropriate. And please like our channel, subscribe to our channel, like our pages. Let's hear our comments and chats in the chat field. Share your thoughts as well on this. Please share this widely with the professionals in your network and even the young ones who are coming to the profession. Thank you for this for joining for this long episode of End of the IFRS Spotlight. We told you Samuel. See you in another episode. Bye for now.